Hello and thank you for watching the goldsilver.com news. My name is Garcia. Friday's default was a historical moment, but before I reveal how historical, let's take a ride through memory lane and see if history can teach us something. Now, you might remember where you were on 9/11, but do you remember where you were on 7/17/07? As Reuters reported then, July 17, 2007, as losses from subprime mortgages began to threaten credit markets around the world, Bear Stearns informs investors in its struggling to hedge funds that funds have very little value remaining. Bear shares end the day at 139.91, while the average target price was 178.23, minus 22%. But the day before, if you look on July 16th, the stock market had just set an all-time high of 14,000 points. People's pensions and retirements were recovering from the crash of '99. Everyone was ecstatic and times couldn't be better. And then the announcement from Bear Stearns. 2 Bear Stearns funds are almost worthless. 2 troubled Bear Stearns hedge funds that bet heavily on risky subprime loans now have very little value, the company said in a letter sent to investors today. But this wouldn't have been a surprise if you had been paying attention to the other markets besides the stock market. By looking at the Case-Shiller Home Price Index and Treasury bonds, you would have seen what was happening. Notice how real estate prices peaked just before 2006, then flatlined, and then started falling on July 1st, 2007. And the U.S. Treasury bonds also reacted by flattening out just after 2006. It was obvious, as Reuters reports on Monday, May 24, 2007. Bear shares closed at 147.55, a 6-week low, after Goldman Sachs slashed its quarterly earnings target for the rival investment bank, citing concern about Bear's heavy exposure to the mortgage securitization business. The average price target then was 181.73. Goldman Sachs saw what was happening, but there was more to reveal. As the graphs indicate, since real estate values were beginning to fall, bonds were going to start rising. Rates and prices generally trend in opposite directions. Also, monetary deflation was about to set in. The Fed had to move fast to protect the petrodollar Ponzi scheme, and move fast they did. As CNN Money reported on September 18, 2007, interest rates slashed to help economy. Fed's dramatic action lowers target on key short-term rate for the first time in 4 years to 4.75% and signals more cuts could be coming. The Federal Reserve cut the target on a key short-term interest rate by 0.5 percentage point Tuesday to 4.75%, and a bold acknowledgement that the central bank is concerned the mortgage meltdown plaguing Wall Street and Main Street could hurt the economy. The Fed also indicated that more rates could be on the way, news that investors cheered, until rates got under 1%. And this culminated by March 14, 2008. J.P. Morgan, backed by the Federal Reserve, provides an undisclosed amount of emergency financing to Bear Stearns. Bear Stearns says its liquidity position had deteriorated dramatically in the previous 24 hours. The stock plunges to close at $30.85. The average price target had been $93.62. Followed by March 16th and March 17th, 2008, J.P. Morgan agrees on March 16th to buy Bear Stearns for $236 million, or $2 a share, representing just over 1% of the firm's value at its record high close just 14 months earlier. The deal essentially marks the end of the Bear Stearns' 85-year run as an independent securities firm. On Monday, March 17th, Bear shares closed at $4.81 on an optimism another buyer may emerge. The average target price was $2. This is an example of monetary deflation. By this time, the stock market had caught on and began its epic slide. But look, now the market is up again, and we just broke 13,000 points. A couple of weeks ago, we just had the first euro, or a couple of days ago, we just had the first euro default. Don't be fooled by the stock market. It's a lie. The higher it goes, the bigger the lie. Just like the unemployment numbers. The lower they go, the bigger the lie. The events resulting from the Bear Stearns scandal was a result of escalating moments in the ongoing battle between the bond wars and the currency wars. Just as Bear Stearns reflected the beginning of the end of the real estate mortgage bubble, I believe the Greece represents the beginning of the end of the bond market. I mean, put yourselves in the put yourself in the bondholders' shoes. For 10 years now, since the inception of the euro, you were able to get repaid whenever you lent sovereign entities money. Now, who knows? The king of bonds, Bill Gross, was quick to retaliate, though, in this bond war, as Zero Hedge reports just a few hours after the Greece default. No more QE. Bill Gross isn't buying it, as total return fund MBS holdings surged to new all-time high. The Fed may be using the Wall Street Journal to spread rumors of sterilized QE, but Bill Gross ain't buying. According to the latest update from the world's largest bond fund, the firm lowered its holdings of cash and synthetic treasury exposure to 38% of a total from 41%, while hiking MBS or mortgage-backed securities to 52%. He's not the bond king for nothing. What does this all really mean? Basically, without saying it, Bill Gross is saying he has more faith in you, the American public, paying back their bills than he does in the U.S. government paying their bills. Now, what does this all mean? At the end of the day, it means that it's still a good time to buy precious metals. But yet, I still get questions about deflation, inflation, and is this a good time to buy? Well, let me go ahead and alleviate your fears. But first, let's watch this short clip from Mike Maloney.
Hi, I'm Mike Maloney, author of Rich Dad's Guide to Investing in Gold and Silver. And actually, most of it is not a guide to investing in gold and silver. There's some monetary history, some of the economics that are behind what is happening right now, so the current state of the global economy. And then there's some potential future outcomes. And my favorite scenario in here appears to be playing out. I said in the book there would be the threat of deflation, to which Ben Bernanke would overreact and do bailouts and such, expand the currency supply, and cause inflation to start happening. And we've seen that inflation happen mostly in the stock markets. I mean, he bailed out the banking sector, and what happened? The banks, I said in a video last November, in November of 2008, I said, you watch, the stock markets will bounce, and it'll be led by the banking sector. And that's exactly what happened. I said in my book that he would respond to this threat of deflation by inflating the currency supply, doing bailouts and such, and then there would be a real deflation that comes on, where the currency supply starts to collapse. So monetary deflation, not asset price deflation, but true monetary deflation.
So as you can see, Mike Maloney believes in monetary deflation and asset inflation. Greece and Bear Stearns represented monetary deflation. The paper bonds lost 75% on Friday, while Bear Stearns stock a few years ago lost 99% of its value. Do you ever really believe gold and silver in this money printing environment will lose 75 to 99% of its value? I don't think so. Now, England has an example of asset inflation. As the Telegraph reports, David Cameron new buy scheme will help unlock housing market. The Prime Minister insists that the government's plan to take an active role in the housing market is absolutely right in order to help would-be buyers struggling to raise large deposits. But critics are quick to push back by stating, state-backed mortgage scheme new buy threatens negative equity. The government's flagship scheme to revive the housing market threats buyers with instant negative equity, a leading analyst warned as it launched on Monday. The article continues with, however, people buying property under the scheme may find themselves in a negative equity trap. According to Alastair Stewart, a longtime industry analyst at Collins Stewart, from a house buyer's point of view, there is a very real chance of instant negative equity, since if this is the only real source of 95% mortgages and is only available on new homes where volumes are near historic lows, there will be short-term upward pressures on prices, which, like buying a new car, will evaporate when the buyers put their keys into the lock. Unlike the Eurozone, which embraced austerity and no QE, the UK is following in the Americans' footsteps by embracing quantitative easing and home buying incentives. Well, it worked great and worked wonders here in the United States, so I'm sure it'll do well with the UK. Now, is it a good time to buy? Absolutely. It's always a good time to buy. Even if you think the prices are going to drop, remember, don't try to time the market unless you're a professional. And remember, the prices did drop in 2008, but even though the prices dropped, the market still affected or felt shortages. As the Wall Street reported then, losing a mint, curb on coin sales angers collectors. U.S. begins rationing popular silver eagles. How $1 fetches $19. The government rationed food during World War II and gasoline in the 1970s. Now it's imposing quotas on another precious commodity, $2008 coins known as silver eagles. The coins, each containing about an ounce of silver, have become so popular among investors seeking alternatives to stocks and real estate that the U.S. Mint can't make them fast enough. In March, the Mint stopped taking orders for the bullion coins. Late last month, they began limiting how many coins its 13 authorized buyers worldwide are allowed to purchase. This came out of nowhere. And then on August 21st, 2008, another article, "The Eagle has been grounded. Mint halts gold coin sales after supply depleted amid price drop." As gold prices tumbled from their highest level ever, investors and collectors loaded up on 1 ounce American Eagle gold bullion coins. The buying spree came to an abrupt halt this week after the U.S. Mint stopped selling the coins for the first time since production began 20 years ago. Due to the unprecedented demand, our inventories have been depleted, the Mint, part of the U.S. Treasury Department, told its dealers Fridays. We were therefore temporarily suspending all sales of those coins. The move shocked sellers and collectors of the coins. A lot of you are new to the gold and silver industry. You might not remember this time in 2008, but Mike Maloney talks about it a lot. He talks about how hard it was to get silver and gold that time, and also states that that shortage will come again. As the prices drop, people will rush in, but suppliers will be hesitant to sell. So it's important you acquire your metals now. Stocks are overvalued, real estate property prices are going down, bonds are now iffy, and forget about cash. So right now the only safe haven where you need to be is precious metals. That's why Bill Gross says it's about return of your money, not return on your money. So don't forget to go ahead and watch the weekly recap on the new YouTube channel, Why Gold and Silver. I'll see you next time. Thank you for watching, and remember, smile. Don't forget to comment and like us or contact goldsilver.com with any questions.